Hello, everybody, and welcome to today's webinar. Today we have Marty Shields, who's a certified financial planner and accredited investment fiduciary, and our newest associate, Nicole Gobel, who's a CPA, just joined us last week, who will be presenting along with myself. And I think you'll get a lot out of today's presentation. So with no further ado, let's get started. Marty, if you can go to the first slide, please. There we go. So we know that the last year has been one crazy year, and as you can see from this little humorous cartoon, everybody getting vaccinated. 2021, it's starting off better than 2020 turned out to be. If anybody thought that the last year wasn't crazy, it truly was crazy. So here we are in 2021, and hopefully we'll give you some insight what we see going forward. But let's talk a little bit about the vaccine and do a summary of last year. Last year turned out to be a great year, as you can see from the large cap, small cap, international emerging market stock holdings. 2020 turned out to be pretty good. The S&P 500 index was up, and this is after being up 32% in 2019. Bonds were up last year. This year it's a different story. We'll talk about that later on. And commodities were down last year, which is no surprise. We'll see if commodities do anything this year. We're actually looking at commodities with inflation rearing its ugly head after spending $6 trillion just in the last several weeks on top of all the money that we spent last year. But Marty has some more information on that. So just real quick, our tactical positions, we try to position the portfolios to look forward. We're always looking ahead. And right now we are on target with our US equities, or I should say overweight US equities, on target with equities. We're at our target weighting, but we like US equities, and our US equity sleeve have always done better than any other sleeve. We're overweight technology. We've been overweight technology for quite some time. Before the Great Recession, I've been overweight technology, and I continue to be overweight technology. I keep saying technology plays a bigger part of our day, as confirmed by today's webinar, using technology. And I think we'll always be overweight technology for the near future anyway. We have some low volatility holdings that we're actually looking to possibly get out of in the next couple days. And we also like dividend stocks. When you look at a stock market return, a lot of the return comes from dividend stocks, and we like dividend stocks. We're overweight there, and we're overweight financials. We were a little bit early to the party when we started overweighting financials, but financials have really been a good place to be. Underweight, we don't own any international equities whatsoever, and we're trying to really look at our fixed income. We're going to be making changes to that, which I'll go over at the end of the presentation, but we're not looking for a whole lot of volatility or high yield debt and fixed income right now. With regards to the coronavirus, I think we have to just pause for a second, and hats off to all the essential workers. And essential workers, everybody from the cashiers at the grocery stores from last year, and you think of the role that they played, not knowing where we were going with coronavirus, to the healthcare workers, to our police and firefighters. There's so many essential workers, and we couldn't have done it without them. Hats off to them, and I continue to thank them when I see them, no matter where they're at. If I know that they've done their job to help us get through the coronavirus, I try my best to make sure that I show my appreciation. So right now, we have just about 35% of the US population being vaccinated. And believe me, folks, we've done a great job getting so many people vaccinated. One dose, 46%, and I think the statistics show after one dose, you have a pretty good chance of being vaccinated, and 32% fully vaccinated. I can't say enough about how far we've come with that. And if we're on track 75% of our population should be vaccinated, just after 4th of July. So there's a lot of good reason to have fireworks this year compared to last year. Vaccines are on the way. So I'm going to stop there. I'm going to let Marty talk a little bit about some of the economic forecasts, and then Nicole about some tax strategies, and I'll come back and round out and give you an idea of where we're headed for the future. Marty?
Thank you, Steve. So if we're going to be talking about where we think either the markets or the economy are headed, we want to look at GDP, which is gross domestic product. And right now, the forecast for the global GDP is almost 6%, which is close to a 50-year high. And the real engine behind this is the US economy. So the numbers just came out this morning for GDP forecast, and it looks like we're going to be somewhere around 6.5% annual GDP growth. And to give you an idea on that, the last time we've seen that level of growth was back in 1982 and 83, and the economy was 1/3 the size that it is now. So real substantial growth. If you remember what we've talked about in the last 10 plus years is really this kind of a new normal of economic growth in the 2 to 2.5% range. So again, this economy is really kind of turbocharged for growth. And one of the areas of real strength in the last year has been the housing market. And as we've talked about, the value and the importance of this is not just the transactions of buying or selling a home, but all the ancillary transactions that occur when you do that. And that's a real positive for the economy. And this is driven in large part by very low interest rates. Really, they're at historical low interest rates. But it's also driven by the fact that there's very low inventory of single family homes, as this graph shows. We're really at a 40-year low. And between these two factors, the strength in the housing market could continue, certainly for the next year or year or two. One of the concerns we've mentioned before is inflation. And as this graph shows, really depending on what inflation metric you look at, we're really still at a very reasonable range. The Federal Reserve puts a target range of 2% as their target for inflation. So in many of the metrics, we're below that. And as we've talked about, the concern with inflation rising too much is the Federal Reserve is going to clamp down on the monetary supply that is providing both through low rates and bond purchases. But right now, inflation looks very reasonable. But expectations for inflation are rising, as this graph shows. And really what we're kind of looking at right now as far as the market with inflation is to have inflation somewhere in the mid 2% range, which is above the Fed's target. But it's important to remember that target is not a cap, meaning that the Fed is fine with inflation moving to this range because what they're looking at is the average inflation over a period of time. So even if it moves to this range, it would not drive the Fed to change their policy dramatically. The other thing to remember is this could be temporary, right? So we could be talking about an increase in inflation because of a spike in demand and also some of the supply issue. But many analysts think that this inflation at that level or higher is not set to continue for a long period of time. When we look at the labor markets, they really have bounced back quite nicely. Actually, when you look at the job openings, it is at the highest level in the last 48 years, number of job openings. And one of the issues that we're unfortunately seeing in the job market right now is with these job openings, you have a lot of folks that are currently on unemployment. And when you look at the state unemployment level they're receiving plus the federal amount, what they're getting is equivalent hourly rate of about $15 per hour, which relative to some of the jobs they might be applying for is greater than that. So, we're seeing this when we talk to small business owners in the capital region, and it's definitely the case that there is a real supply shortage for labor. And the problem with this is potentially that if inflation gets into the labor markets in a dramatic fashion, that can be one where it can get more difficult to remove and it can be more long lasting, in which case the Fed would be probably inclined to act in a more dramatic fashion. So again, this is something that we're watching very closely to see how much this actually flows to the overall inflation in the economy. So really what has been just a huge tailwind for the economy is the Federal Reserve and its monetary policy. And as this graph shows, the Federal Reserve rate, which is the rate that the Federal Reserve sets for banks, it was pretty close to zero from 2008 up to 2015. And then last year, they brought it way down, back down to just above zero. And in their meeting yesterday, their announcement was that they expect to keep it at that rate for the next probably 2 or 3 years. The other program they have out there that really is providing a lot of liquidity to banks and to the economy is their bond buying purchases. And right now it's billions of dollars a month that they're going out into the market and buying bonds, which is keeping rates very low. And it's doing exactly what the Fed wants it to do, which is to have people move assets out of very safe areas like CDs into the market, and to take on more risks like mortgages and loans for businesses. And that's what's happening out there in the markets, in the economy, and that's the intention of what the Federal Reserve wants to do. Now, to talk a little bit about yield curves. So we've talked about yield curves over the last 3 years or so. And again, just a reminder, a yield curve is just looking at the interest rate that you receive for different maturity levels for Treasury notes or bonds. So we're looking at the yield you receive for everything from a 3-month note all the way out to a 30-year Treasury bond. And if you remember, in 2018 and 19, our concern was that you could have an inverted or flat yield curve, which would indicate an unhealthy economy. Whereas what we're seeing now is the yield curve starting to steepen, right? So the purple line is the yield curve from last year. And you can see the blue line, which is the yield curve now, that's steeper than it was last year. And there's indications that we can move more towards we were in 2013, which was a fairly steep yield curve, and it indicative of a healthy economy. So again, something we'll be watching. And this is also, as Steve mentioned, we're overweight in financials. This is also very good for banks because they borrow at the short end of the curve and they lend at the long end. So they start making a lot of money when this yield curve steepens in a healthy economy. One of the things that we've also talked about a concern is valuations, right? So in general, we talk about the PE ratio of price to earnings. What are you going to pay for $1 of earnings for the stock price? And as this chart indicates, there are a number of different ways to look at valuations, and many of those have been stretched. So they're over on the right-hand side, meaning that they're way above kind of their average. And there's 2 ways to rectify that issue. Either prices go down, which really nobody wants because that means the market's declining, or earnings go up, which is what everybody's kind of hoping for. And the fact of the matter is that's what we're seeing. So as of yesterday, about 1/3 of the companies in the S&P 500 have reported earnings, and 84% of those companies beat analyst expectations. And it's not the fact that they just beat analyst expectations, but they beat them by 24%. And to give you an idea, in general, the last 5 years, when companies have beat analyst expectations, it's more in the neighborhood of 6 to 7%. So they're beating expectations by a wide margin. There's a lot of companies doing that, and they're also increasing what their forecasted earnings. And this is what this chart shows you, which is the checkered bars there are the forecasted earnings. And you can see that quite dramatically increasing from where we were over the last year. So this would be the better option for rectifying those high valuations. And it's shown in this graph, right? So the orange line is the actual earnings for the S&P 500. And you can see they dropped in 2019 and 20, while the price to earnings ratio, the blue line, jumped quite dramatically in 2020 and early 2021. But if the actual earnings kind of come in line with the forecast, you're going to see earnings continue to increase and the price to earnings ratio or valuations decline, which is a really good thing and definitely makes you feel more comfortable with buying in at certain valuation levels in the market. One of the areas we've talked about quite a bit is inflation. And inflation can be a problem, certainly as a bondholder, right? Because what that means, as I mentioned, that the Federal Reserve would have to act if inflation becomes high and sustained for a long period of time, and they would be pushing rates up, which would be a negative to bonds. But what this chart shows you is how different asset classes react for certain inflation levels. And what you can see is we're in the bottom quadrant, left-hand quadrant here, and we're in a low inflation environment, but rising. And in many cases, this can be good for stocks. In this type of environment, stocks can actually do very well in this type of environment. So, we'll probably, as Steve mentioned, be looking to make some adjustments on the bond side. But overall, for equities, low inflation and rising inflation can be beneficial. But when we talk about different asset classes and valuations, there's certainly some that are, let's just say, more than frothy. I don't know if you use term bubble, but you know, we've talked about different asset classes, and one of them is Dogecoin, which is a cryptocurrency that you may have heard about in the press. And it was actually started in 2013 by two IBM engineers, and it was started as a joke. It was a satirical cryptocurrency. But the fact of the matter is that there are a lot of people who are buying it. And right now, the valuation of this Dogecoin is worth more than a number of these companies listed here, right? So Barclays and Hyatt and Halliburton, the value of this joke cryptocurrency is actually higher than these larger companies. So again, there are areas and asset classes that are definitely frothy, but from an overall market perspective, as it indicated, things don't look too bad. So just to recap, so again, the economy is kind of in a mid-cycle or early cycle of this recovery. It's likely to be hotter and shorter than prior cycles, right? So the last cycle was a very kind of slow growth, but very long cycle. This could be shorter, certainly in comparison to that cycle. A lot of the reopening stocks have recovered from where they were, but now what you're seeing is a reflation trend that can still be beneficial to the market. Inflation from labor costs is our primary concern as we look at if inflation is going to be more short-term in nature from kind of this increased demand and supply situation, or if it's going to last longer than maybe expected. And right now, from a valuation perspective, things seem to be moderating. All right, we're going to go on to Nicole as she gives us some insight on the some tax tips and what we might be seeing for tax changes coming down the pipe.
Thanks, Marty, very much. So yes, of course, everyone has heard that there's some potential changes with the new administration. So why don't we take a few minutes just to go over what that might look like for you as an individual or as a business owner. So why don't we start first with the individual taxes. Marty, if you'll move to the next slide. Great. So there are certainly some potential tax increases coming in the new proposal. Now, we do believe that really the higher earners, the higher income level, above $400,000 of annual adjusted gross income, that's really where they're looking to make initial changes. You may recall that right now, the highest tax bracket is 37%. So the proposal would go back up to that 39.6% from the Obama era, rather than that 37%. Now, that might not make a huge difference to, the general population. However, there's another bigger change that would be implemented potentially on long-term capital gains. So right now, the long-term capital gains tax rate, so that is the taxes you would pay on any investments that you hold for more than a year, the maximum that any high earner would pay today is 23.8%. So on the federal level, so 20% plus a 3.8% net investment income tax from the Obama era. If the second bullet point here, that those earners above 400,000 are subject to ordinary tax rates, that means that 43.4% would be the tax someone would be paying on a long-term capital gain transaction. So that could be very substantial. So again, if this is something you're concerned about within your investment portfolio, talk to our team, because of course we have strategies to work with you, to ensure we're really taking gains over a longer period of time and negating, that tax effect over your portfolio. Now, there's two other potential positives on the individual side that I've come across. So you may recall that the SALT, the state and local income tax deduction, was capped at $10,000 in the most recent legislation. And what that did for many of us who live in the New York, New Jersey, Connecticut area is if we owned a home and we were paying state income taxes, we really lost out on a significant amount of our tax deduction related to taxes paid on our home or to, again, the state income tax. So if they removed that $10,000 cap, that could be a positive. And for many of us, we might go back into using itemized deductions versus the higher standard deduction that came out a few years ago. However, again, looking to limit the effect of this, because it could cost billions of dollars to do this, instead, they would impose a phase out for higher income earners that not everyone would get to deduct all of those taxes paid. And right here, another one would be an increase in the child's tax credit. So again, just trying to look at a couple of the positives This could go from $2,000 per child to $3,000 and $3,600 for those under 6. So the corporate taxes, this is another big one. So right now we're in a really low corporate tax environment of 21%. The proposal would go to 28%. We're thinking there might be more of a middle ground around 25%. And again, this is all just at the federal level. Also, earners over $400,000 could lose that qualified business income deduction, the 20% deduction that was put in place a few years ago as well. So that's something to think about as a small business owner, and certainly talk to our team and talk to your CPA. And also on the corporate side, there are both incentives and credits for companies to keep business and jobs in the US, as well as penalties for those that are moving operations and jobs overseas. In fact, one of the things they talked about specifically was call centers. And again, a penalty for moving those type of jobs overseas and a credit or incentive for keeping them in the US. So talking a little bit about the New York state legislation. So just about 10 days ago, this legislation was passed that moved the top tax rate that was 8.82% for those with earnings over 2.155 million to 9.65%. What they also did was increase or add 2 new tax brackets. So those earning over 5 million now we're at 10.3%, and those making over 25 million increased to 10.9%. So those are some substantial rate increases for those in the high earning brackets. The corporate franchise tax was also increased from 6.5 to 7.25. And there is an optional pass-through entity tax. So that means if you're a business owner, own an S Corp or a partnership, instead of paying that tax only on the individual level, this is really a way to try to get around that SALT, the state and local income tax deduction. So this could be a positive for many business owners. So what should we do? So basically on the estate tax, that's another proposal that's on the table. So right now, you may know that the exemption for any individual is $11.7 million. So only estates above that level, $23.4 million for a couple, are being taxed at the federal level, and the rate is 40%. There's a couple proposals on the table. One would raise the estate tax rate to 45%. If nothing is done, the exemption is due to sunset to $5 million, which was the 2017 level, in December of 2025. There's the thought that they'd want to reduce the exemption to that level today, or even down to $3.5 million per person, which would be the 2009 level, and the gift tax exemption down to $1 million. So that would be a substantial decrease and really make quite a few more estates taxable at the federal level. And another big one that really hasn't come into play before is the repeal of a basis step up. So what that means is when you pass away and your heirs receive assets that might be in your taxable investment account, right now they get a step up in basis to the fair market value, so that your heirs don't need to pay the capital gains on those assets that you've held over time. This would potentially take that away, and any assets in an estate over 2.5 million would not get that basis step up. So that would be, again, a big hit to many estates. So what can we do today? Well, again, talk to our team, talk to your CPA. We're happy to get involved. Think about gifting, right? So $15,000 per person, you can gift to any individual each year. You can gift to a 529 plan and do 5 years of gifting in 1 year to children or grandchildren. You can also set up trusts, irrevocable trusts, so that items are out of your estate, well before anything is needed on the estate tax exemption. You can donate to charity. So if you're already charitably inclined, there are tax efficient ways of doing this through your required minimum distributions from your IRAs if you're over 72, or donated appreciated assets. As we talked about before, the long-term capital gains rate could almost double. So thinking about donating appreciated stock or funds, versus donating cash could be a great way to save on the taxes while also, again, fulfilling your donations to charitable organizations. And review your current retirement funding strategies. Are you maximizing your tax-deferred savings? Again, especially if you're a business owner, there are many different types of plans you can talk to our team about setting up that can defer additional money and, again, save you on those higher income taxes, both at the state and federal level. And does the Roth strategy make sense, either saving today or thinking about Roth conversions? So definitely something to, again, talk to your advisor about to determine, is there something else you can be doing to prepare for these potential changes?
Great. Marty, thank you. You and Ryan always are wonderful on these webinars, putting together some great information. And Nicole, for your first debut with our clients, I can't thank you enough. I know that with all that, the chatter that we listen to regarding taxes, there's going to be a lot of talk and a lot of strategies to play out. And we are committed to that, as you can see. Nicole joining us, being a CPA with all of her experience. I sent an email out last night to have you look at Nicole and the rest of our team. We also have some new additions coming on over the next few weeks. You'll hear more. One of the 3 new professionals that we're hiring is also a CPA. So we're committed to looking at the future. We really think that managing our clients' wealth and keeping taxes in mind is important. But let me just talk about where we're at right now with the economy. As Marty pointed out, we've come a long way over the last year. A year ago, we saw the most historical, quickest, fastest correction on record, down 34% in a few short weeks, and then all of a sudden we recovered, came out of a recession quicker than we've ever come out of a recession. As we sit here today, the S&P is up about 12% year to date on top of last year in 2019, and we can go back over the last 12 years since the Great Recession ended in March 2009. We are optimistic on the stock market. With all the headlines and news, I always try to remind investors that stocks truly trade on the fundamentals. How is the economy playing out? Is corporate America earning profits? And right now, just about 86, 87% of all companies that have announced earnings beat expectations, and that's good news for corporate profits. We're putting people back to work. We're still approximately 9 million people are still out of work from where we were at the beginning of this coronavirus. Back last April, we lost as many as 22 million jobs. So we recovered a lot, but we still have a lot more to recover. Marty kind of pointed out that labor inflation, and it's something to think about. I know right now there's a lot of small businesses that can't get any help because people are being paid to stay home. Maybe they came out of the workforce. They just don't want to look. Whatever the reason is, people can't find help. And the jobs are there, as Marty showed us. The jobs are there. I know we have 2 clients. One client is closing up shop for the summer because it's a restaurant, he just can't find help. Another client had 11 interviews set up and not one person came for the job interview. So I think that when we look at the future of the employment, hopefully we'll continue to put people back to work as the economies open up. We talked about the vaccination. There's light at the end of the tunnel. A lot of people have paid a dear price through COVID-19, and now people want to get back to some sort of normalcy, and we're not sure what that normalcy will be, but we know that hopefully the near future will be very, very good compared to what the last 12 months will be. When it comes to the portfolios, being optimistic on the stock market, we never know when that next correction, when that next bear market or recession will happen, but it will happen. And when it happens, our clients don't panic because I think we take the time to help educate them. And there's some good news today on the market. When you look at your stock holdings in your portfolio, and remember, 100% of my family's money is managed just like yours. I'm a little bit more growth oriented because I'm very comfortable with risk. Some clients are more conservative, but all in all, we own the same investments. I wouldn't have it any other way. And when you look at your top holdings, your holdings are Apple, Microsoft, Amazon, Tesla, JP Morgan, Facebook, Berkshire Hathaway, Google. Those are the top holdings in your portfolio. Even though we're buying exchange traded funds, we can break out any information you want to ever see. Paolo LaPietra is working hard behind the scenes with trading and really putting a lot of great reports together. So if you ever want to see anything specific on your portfolio, please just ask. We have that. So as I said, we're optimistic going through the next several months, we're going to be making some tweaks in the portfolio to take advantage of the consumer. Remember, the consumer has a boatload of money. They've gone a year of not hopping on a plane, not taking a vacation. They couldn't go out to dinner, see a movie. They're not walking through the malls buying items they don't need. So they have all that money saved up. And on top of that, the stimulus checks that have been sent out. So the consumer is looking to spend some of that money, and the consumer drives 2/3 of the economy, which is why we're optimistic from a stock standpoint. And we're not so nervous. Just because the stock markets are at all-time highs, we don't think they have to correct, but they will. We just don't know when, and when they do, they'll recover. And this is something that we truly believe in, which is why we keep 2 years of any money that clients need over the next 2 years, any money they need, we keep out of the stock market so they don't have to worry. Well, with that being said, as you can see, hopefully this information helped. Hopefully you're comfortable with what you saw today, and we'll follow up more with, I think we're going to be doing more of these webinars on different topics because they're so popular with our clients. In the meantime, let me sign off by saying thank you. Behind the scenes, we have Harmony Wagner and David Clark, who played a big role in putting this webinar up. I appreciate you taking time out of your day. Stay safe, stay healthy. Talk to you soon. Bye-bye.